All right, guys, controversial take here. You don't need a portfolio for your retirement. What you actually need is a paycheck machine. And my question to you is, if the financial markets were to crash 30% next year, would your machine still be paying you? If not, let's look at how we can build one with 3 distinct buckets. Quick note before we start here. This is not a one-size-fits-all approach, and this is not universal advice for every single person watching. It may or may not be appropriate for you, and I would encourage you to consult with a financial planner before implementing what I share with you in this video. Retirement investing isn't just one big pile of money. As we already mentioned, you can look at it as 3 distinct buckets here. Cash for your spending now, income a little bit later to refill the cash, and then you have your growth, last but not least, to help try to keep pace or outpace inflation over time. Bucket 1 is your cushion. This is where you can consider holding 1 to 3 years of withdrawals in safer, traditionally safer assets like high yield savings, T-bills, or short-term CDs. These funds help your monthly spending, especially during market downturns, and will also allow you to prevent selling stocks while they're down at inopportune times. Bucket 2 is the income and stability bucket. This is where you'll find things like high quality bonds, treasuries, and bond ladders, and probably dividend paying stocks as well. Its job is to refill bucket 1 as you move forward through time. Keep it measured, not exciting. Bucket number 3 is where it may get a little bit more exciting. This is where you'll find your growth, your stock, your equity, potentially REITs in moderation and if suitable in your case. Its job here in bucket 3 is to raise the long-term rent of your portfolio, and when the market rises, this is where you may want to consider trimming off of bucket 3 to refill bucket 2, which then refills bucket 1. You want to size these changes by year to year and by what's going on in the economy. 5 years from retirement, your pre-retirement bucket 1, this is where it may look like, again, 12 to 18 months of cash for your expenses. Bucket 2, 35 to 45% in those income producing assets. And then bucket number 3, you're gonna have 40 to 50% in those longer term growth assets. When you transition to early retirement, this is where the numbers will start to change a little bit, right? You may have 12 to 36 months in cash, 40 to 50% in income, and then 25 to 35% in growth, right? So the point here, guys, is there's not really a magic number, and this is something that you're gonna have to work with a planner on to change year by year, and as you progress through different stages. Also want to take into consideration what your risk tolerance is and other unique circumstances you have. So these are ranges, they aren't rules, and you may want to consider adjusting these ranges for other things you may have, like pensions, your tax, as I already mentioned, your risk, your health circumstances, and you may want to consider rebalancing once a year. And if stocks were to run hot, that's where you could consider skimming some of the gains into bucket 2, and then that would then feed bucket number 1. So it's really a huge cycle, and it's an ecosystem that should feed itself over time. And as the markets recover, that's where the bucket 3 will do better, and then it'll allow you to help with bucket 2 and bucket 1. So fixing the common mistakes here, if you're too aggressive at first, then that's where you just kind of keep it simple and you add a little bit more cash to bucket 1, or you shift more into the higher quality bonds in bucket 2. And if you're too conservative, then the inflation is starting to tax you silently over time, and that's where you may want to move, a few percentage points higher into bucket 3. You don't want to tweak this weekly, you want to review it annually, as I already mentioned, but you certainly want to ignore the headlines and sort of the outside noise that I think gets in the way with this. Cash drag, it buys time, but not returns, right? So that's why in bucket 1, you don't want to be too heavy. Is this market timing? I would say certainly it's not market timing. It's a mechanical process with pre-decided refills and trims based off of certain things that were to happen, right? Certain events, let's just say. So if this seems like something that makes sense to you and you'd like to learn more, as I stated in previous videos, this is what I do every single day. I help retirees just like you try to find the best strategy for them with their retirement income withdrawals. So this may be a good fit, it may not be a good fit. You don't really know until you put pen to paper and you start to map everything out with all these different factors we talked about: inflation, taxes, your health situation, and we really, as I said, look at it from a longer term perspective. So my name is Patrick Hammond. I am the co-founder of Guardian Financial Services. I'm a certified financial planning professional, and I want to just say I appreciate the time you've given me here today, and if you'd like to learn more, consider looking at the links in this video below. And if you'd like to have a complimentary consultation with me or someone else in my office, then consider reaching out to us below as well. Thank you so much, and I'll see you in the next video.